On Wednesday, I showed you where to build, the gaps between your core platforms where no vendor controls access. Yesterday, we covered the government risk that makes tool-agnostic workflows absolutely essential. Today, I'm showing you how fast the window to build is closing. And the data on this one is hard to argue with. Let's get into it. Anthropic, the company that makes Claude, published something last week that I think every CAS practice owner needs to think about. They took their actual usage data and mapped it against 800 occupations. Not what could AI theoretically do, what it is actually doing in real workflows with real users. The headline numbers: computer programmers, 75% AI coverage. Customer service reps, 70%. Data entry, 67%. Financial and investment analysis, 57%. But those aren't the numbers I want you to focus on. The number I want you to focus on is this one: business and financial operations. That's us, that's our category. Shows 85% theoretical AI capability. AI could handle 85% of the tasks in bookkeeping, accounting, and financial analysis roles right now. But the actual observed usage, 20%. That's a 65-point gap. Now, your first reaction might be relief. Oh, phew. Okay, AI is only doing 20% of what it could. We've got time. But that's the wrong read, and here's why. The gap isn't a capability problem. The AI can already do the work. The gap is an adoption problem, and adoption problems close fast. Look at data entry. 2 years ago, AI coverage for data entry keyers was negligible. Today, it's 67%. That didn't happen gradually. That happened in the time it takes most firms to finish an implementation plan. Financial roles are next in line. And the 65-point gap between what AI can do and what it's actually doing in our profession, that's not a buffer. That's a window, and it's closing. Now, here's where this connects to something we've been talking about for the last couple of weeks: the talent trap. Anthropic's data shows that hiring of workers aged 22 to 25 has slowed 14% in AI-exposed occupations since ChatGPT launched. 14%. That's not a projection. That's measured. And the Bureau of Labor Statistics projects that for every 10% point increase in AI coverage, employment growth drops 0.6 percentage points. Now apply that to financial roles as coverage climbs from 20% towards 85%. The math gets uncomfortable very quickly. This is the compounding problem that I need you to really think about. The entry-level work that used to train junior accountants, data entry, bank reconciliations, transaction coding, is exactly the work that AI automates first. It's the commodity layer. So you're not just losing tasks to automation, you're losing the training pipeline that produces the people who do the tasks that AI can't do. The advisory work, the client relationships, the judgment calls that require context that no model has. Now, the Journal of Accountancy asked this exact question last week: how will accountants learn when AI does the foundational work? Anthropic just handed us the data to answer it. Okay, so what are the firms in that 20% actually doing differently? They're not just using AI more. They are structurally different. They have champions, people inside the firm who experiment, who fail, who iterate, and who build repeatable workflows. And they have operators who take these experiments and turn them into standard processes. And critically, this connects to Wednesday's piece. They are building in the gaps, the workflows between platforms that no vendor controls. That's the work I mapped out earlier this week. The 20% firms are already there. That's the champion and operator dyad we talk about. It's not a theory. It's what separates the 20% from the 80%. And yesterday, we covered why building a tool agnostic in the gaps, not locked into a single vendor, protects you from the government risk that's reshaping the landscape. The 20% firms get that too. And here's the part that matters most for where you invest your energy. The work AI can't touch is the work that requires your data edge. That's your client context, your relationship history, the pattern recognition that comes from years inside a business. That's your advisory layer. And it's defensible because no model has that information. But here's the tension. You can't pivot to advisory if your team never learned the fundamentals that advisory is built on. And you can't build a training pipeline around work that's been automated out from under you. That's the real strategic problem. Not whether AI is coming for compliance work. It already is. The question is whether your firm is building the capability to move up the value chain before the window closes. So here's the bottom line. The 65-point gap between theoretical capability and actual adoption in financial roles is your strategic window, not your comfort zone. Every month that passes, the tools get better. The prices drop. We covered this on Monday when we were talking about the ChatGPT 5.4 news. And the earlier movers compound their lead. The gap will close. The only question is whether you're inside it, building capability, or outside it, watching it close. This week, we've given you the big picture. On Tuesday, we discussed the Sequoia strategy. On Wednesday, I showed you where to build, the gaps within your platforms. Yesterday, we covered the government risk that makes tool agnostic essential. And today, the timeline, how fast the window between what AI can do and what it's actually doing in our profession is closing. These pieces all connect. The window is real and it won't stay open. So here's what I want you to do. Go to theaiaccountant.ai/scorecard and take the free AI readiness scorecard. It's 25 questions, take you less than 5 minutes, and you'll know exactly where your practice stands relative to what's coming, where you're strong and where you've got gaps, and what to do about them. Because the data isn't theoretical anymore, and neither is the timeline.